ETFs, or exchange-traded funds, are one of the easiest ways to start investing, even if you're brand new to the market. Think of them like a basket filled with many different stocks or bonds, so you're instantly diversified without having to buy each one individually. They trade on the stock market just like regular shares, meaning you can buy and sell them anytime during the day. With low fees, flexibility, and simple diversification, ETFs are perfect for beginners who want to grow their money without constant stock-picking stress. Today we will talk about Beginner's Guide to ETFs. So before we start, make sure to hit the like button and subscribe to my channel. 1. What is an ETF? An exchange-traded fund, ETF, is a type of investment fund that pools money from multiple investors to buy a collection of assets, such as stocks, bonds, or commodities, and then trades on stock exchanges like individual shares. Unlike mutual funds, which are priced once daily, ETFs can be bought and sold throughout the trading day at market prices. This flexibility makes them appealing to both beginners and experienced traders. ETFs are often designed to track a specific index, such as the S&P 500, giving investors broad exposure to a particular market segment. They combine the diversification of mutual funds with the liquidity of stocks, making them a popular choice for passive investing. ETFs also offer transparency, as their holdings are usually disclosed daily, and they tend to have lower expense ratios compared to actively managed funds. For beginners, ETFs are a low-cost, accessible way to start investing with instant diversification. 2. How ETFs work. ETFs operate by holding a portfolio of securities that represent a specific index, sector, commodity, or investment strategy. When you buy an ETF share, you're essentially buying a small portion of every asset it holds. ETF providers such as Vanguard Shares or SPDR create these funds and list them on stock exchanges for public trading. Market makers ensure liquidity by constantly buying and selling ETF shares, keeping their prices close to the net asset value (NAV) of the underlying assets. ETFs can be bought in the same way you'd purchase stocks, through a brokerage account, without minimum investment requirements. Since they trade like stocks, investors can use strategies such as limit orders, stop losses, or even margin trading. Dividends from the ETF's holdings are often distributed to investors or reinvested. This simple structure allows for instant diversification, easy trading, and the ability to build a portfolio without having to pick individual stocks. 3. Types of ETFs. There are many types of ETFs, each serving different investment goals. Index ETFs track major stock market indices like the S&P 500 or NASDAQ 100, giving investors broad market exposure. Sector ETFs focus on specific industries like technology, healthcare, or energy. Bond ETFs provide access to government, corporate, or municipal bonds, ideal for income and stability. Commodity ETFs allow investment in gold, oil, or agricultural products without physically owning them. International ETFs give exposure to markets outside your home country. Dividend ETFs invest in companies with strong dividend-paying histories. More advanced options include leveraged ETFs, which amplify returns and risks, and inverse ETFs, which aim to profit when markets fall. Beginners often start with broad market index ETFs due to their diversification and lower risk. Understanding the types helps investors choose the best fit for their goals, whether they want growth, income, or sector-specific opportunities. 4. Benefits of ETFs. ETFs offers several advantages, especially for beginners. Diversification is a major benefit. You get exposure to many stocks or bonds in one purchase, reducing the risk of a single investment dragging down your portfolio. Low costs make ETFs appealing, as they usually have lower expense ratios compared to mutual funds. Liquidity means you can buy and sell them anytime during market hours, unlike mutual funds that settle at the end of the day. Transparency ensures you know exactly what assets the ETF holds, as most providers publish daily holdings lists. Flexibility lets you choose ETFs for growth, income, or hedging strategies. Tax efficiency is another perk. ETFs typically generate fewer taxable capital gains than mutual funds due to their unique creation and redemption process. For investors looking for an easy, low-cost, and flexible way to invest, ETFs are an excellent choice for building long-term wealth. 5. Risks of ETFs. While ETFs have many benefits, they are not risk-free. Market risk means the value of your ETF can decline if the market or sector it tracks goes down. Tracking error occurs when the ETF's performance doesn't perfectly match. the index it's supposed to follow, often due to management fees or operational issues. Liquidity risk can be a problem for niche or low-volume ETFs, making it harder to sell shares quickly at a fair price. Leverage risk affects leveraged ETFs, which can amplify both gains and losses, making them unsuitable for beginners. Sector concentration in specialized ETFs can also increase volatility. Additionally, some ETFs may hold complex derivatives, which carry extra risk. Beginners should avoid overly complex or speculative ETFs and focus on broad, diversified funds. Understanding the risks and doing proper research before investing helps ensure ETFs remain a safe and effective tool for portfolio growth. 6. How to choose an ETF. Selecting the right ETF starts with defining your investment goals, whether it's long-term growth, steady income, or diversification. Look at the underlying index to ensure it aligns with your strategy. Review the expense ratio, as lower fees mean more money stays invested over time. Check liquidity by examining the ETF's average daily trading volume and bid-ask spread. Analyze historical performance, keeping in mind that past results don't guarantee future returns. Investigate dividend yield if you want income-focused investments. Also, research the fund provider. Established names like Vanguard shares and SPDR tend to have strong reputations. Beginners may prefer broad market index ETFs like those tracking the S&P 500 or total market indexes for simplicity and stability. Avoid highly specialized or leveraged ETFs until you're more experienced. By focusing on low-cost, diversified ETFs that match your risk tolerance, you can build a strong foundation for your portfolio. 7. How to invest in ETFs. Investing in ETFs is straightforward. First, open a brokerage account with a platform like Vanguard, Fidelity, Schwab, or Robinhood. Once funded, search for the ETF ticker symbol and place a buy order, similar to purchasing a stock. You can choose between market orders, buying at the current price, or limited orders, setting a specific price. Consider using dollar cost averaging, where you invest a fixed amount regularly to reduce the impact of market volatility. Many brokers also offer commission-free ETFs, lowering costs even more. Decide whether you want to reinvest dividends automatically or take them as cash. Beginners should start with small amounts and gradually increase investments as they learn. Keep track of your ETFs, but avoid checking prices obsessively. ETFs are best suited for long-term holding. Over time, consistent contributions to diversified ETFs can help grow your wealth steadily without the need for active stock picking. 8. Common ETF strategies. ETFs can be used in various strategies to suit different goals. Buy and hold investing is the most common, where you purchase broad market ETFs and hold them for years to benefit from long-term growth. Core satellite strategy involves using a broad ETF as the portfolio's core and adding smaller positions in specialized ETFs for growth opportunities. Sector rotation uses ETFs to move money into strong-performing sectors and out of weak ones based on market cycles. Dividend growth investing focuses on ETFs that hold companies with rising dividend payouts. Hedging can be done with inverse or commodity ETFs to protect against downturns or inflation. More advanced investors might use options trading on ETFs for income or protection. Beginners should start simple, usually with a low-cost index ETF, and avoid frequent trading. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.